Hey everybody, continuing with the theme of tax planning and of course how to bring down what you're going to owe Uncle Sam. Today I'm going to cover a common question that I get, which is, will capital gains push me into a higher tax bracket? First, it is important to distinguish between our 7-bracket ordinary income tax bracket rates and our lower 3-bracket capital gains and qualified dividend tax rates, which of course I have discussed before, but let's revisit this distinction just in case it's the first time that you've listened to a video. First, let's go over some of the lower ordinary income tax rate brackets for 2023. If you are filing as an individual and earning up to $11,000 this year, or if you are married and filing jointly and earning up to $22,000 this year, you will be in the lowest ordinary income tax bracket, which is 10%. And if you are filing as an individual and earning over $11,000 and up to $44,725, or if you are married and filing jointly and earning over $22,000 and up to $89,450, you're going to be in the 12% ordinary income tax bracket. Now, the 12% ordinary income tax bracket, which is of course in the higher 7 bracket rates in the US, closely coincides with the 0% lower 3 bracket system for capital gains and qualified dividends. What does that mean? Well, it means that if you are married filing jointly and you have about $90,000 in income, I rounded up a little bit, and excluding any deductions, you would have to pay about 12% in taxes if it was ordinary income. If it were long-term capital gains or qualified dividends, you would pay 0% in taxes. That's right, 0. So obviously the 3 bracket rates are much preferred over the ordinary income tax brackets that we have right now. And I know I rounded up to $90,000 for simplicity's sakes, but to clarify, the capital gains rate threshold for 2023 is about $44,625 for individuals and about $89,250 for married filing jointly. So there's about a $100 difference between the thresholds for individuals and about a $200 difference for married couples filing jointly. And just as a little FYI, the 15% capital gains bracket, it goes from $44,626 to $492,300 for individuals, and from about $89,451 to $553,850 for married couples filing jointly. So, as I said, a very big bracket. And anything over those amounts is going to be taxed at 20%. So definitely preferred what would be a 35 or 37% bracket if you had ordinary income that was that high. As I mentioned, in 2023, if you are single and you earn about $44,625 or below, or married and earn $89,250 or below, you could pay $0 in taxes on your long-term capital gains up to each one of those respective thresholds. If you reach and go over those respective thresholds into what would be the 15% capital gains bracket, the long-term capital gains in the lower brackets are still taxed at 0%, but anything over that rate is going to be taxed at the 15% capital gains rates. And if you have ordinary income, all of that capital gains and qualified dividend income in their respective tax bracket is going to stack on top of your ordinary income. Well, what the heck does that mean? Clear as mud, right? Well, let me give you a little example. So ignoring any credits or deductions, let's say that you are married and you have a combined income of about $60,000, and you're also going to have some long-term capital gains of about $40,000. So you're going to have a total income of $100,000. But remember, different income types get taxed different ways. First, the $60,000 is going to be taxed at the 7 bracket ordinary income tax rates. But the question was, will the $40,000 in capital gains push me into a higher tax bracket? Well, the answer is yes, but only in the preferred 3-bracket lower rate system consisting of capital gains and qualified dividends. Continuing with the example, of the $40,000 in capital gains, $29,250 or the $89,250 threshold minus $60,000, which is going to be the $29,250, that is going to be taxed at 0%, and the long-term capital gains and qualified dividend tax rate. And $10,750 or $40,000 minus $29,250 will be taxed at the 15% capital gains rate. Back to the main question. Will capital gains push you into a higher tax bracket? Capital gains will not cause your ordinary income to be taxed at a higher rate. So this is obviously good, but capital gains will increase your adjusted gross income or AGI. And this can cause you to lose eligibility to contribute to an IRA or a Roth, and it could also cause you to be phased out of some itemized deductions and some different tax credits. So again, long-term capital gains and qualifying dividends are taxed at different rates and separately from your ordinary income. Your ordinary income is going to be taxed first at its higher relative rates, and then long-term capital gains and dividends are going to be taxed second at their lower rates and stacked on top of your ordinary income. So long-term capital gains can't push your ordinary income tax into a higher tax bracket, but they may push your capital gains rate into a higher tax bracket. And it is also very important to distinguish between short-term and long-term capital gains, since short-term gains are taxed at the same higher rates as your ordinary income, and long-term capital gains are taxed at the preferred lower rates of our three-bucket system. And again, knowing the tax code and associated financial tools can lead to many tax planning opportunities to lower what you're going to pay Uncle Sam over your lifetime. Thanks, and I will see you in the next video. Once again, Tim Doehrmann here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.